I've actually been at Pimco for almost 25 years. My 25th anniversary with the firm is quickly approaching. In about 3 months' time, we'll have our official 25-year anniversary. In my current role at Pimco, I am the Group Chief Investment Officer. And what that means is that I'm responsible for overseeing the entire investment process across the firm. And that includes overseeing our activities within the public markets, more traditional fixed income portfolios, as well as various hedge funds. And then about 15 years or so ago, I was responsible for branching out and developing a lot of the private areas of our investment process that we continue to focus on today. So private corporate credit, private real estate, even various quantitative strategies and other types of investments targeting opportunities within the private space. And then finally, in addition to my responsibilities overseeing the investment process, chairing the Global Investment Committee, I also on a day-to-day basis still am responsible for managing a variety of portfolios. We do. We believe after the significant increase in interest rates over the course of the last 2 years, we're back to a level of yields that are quite attractive for end investors. Although we're off the high in yields, we've seen a decent rally in the bond market over the course of the last couple of quarters. When you look at yields today and you compare them to where they've been for much of the last 2 decades, we're finally back to levels, again, that are quite high from a historical perspective and quite attractive for end investors. So we do believe that fixed income should be an area of focus across portfolios. You have the ability to put together portfolios of very high quality. And we are excited about the opportunities not only to generate attractive yield, but also the potential for additional price appreciation. That price appreciation would likely occur if and when we end up seeing more weakness in the global economy. So we do think that bonds are back in the sense that they are currently representing good value, both in an absolute sense and also good value versus other alternatives in the public equity markets, even in certain areas of the private opportunity set as well. Pimco sees opportunity in a few key areas of the global fixed income opportunity set. Across the public markets, we do believe it makes sense for investors to stay up in quality, to have exposures to the highest quality, most resilient areas of the global fixed income opportunity set. And one of the reasons for that view is that we do think that there's going to continue to be significant economic uncertainty and a risk of a more meaningful global economic slowdown. So right now, we're very excited that in US dollar terms, you can put together a very, very attractive, defensive, high quality portfolio with yields in the 5, 6, even close to 7% range. So we do have a strong preference for high quality risk, investment grade risk, collateralized or even asset-backed type securities that have additional credit protections relative to what you can get in the corporate debt market. We're a bit more cautious in the more economically sensitive areas of the market. So less inclined to be investing aggressively in the lower rated senior secured bank loan space, or even expressing a little bit of caution, or at least being much more selective in looking at opportunities within the high yield corporate bond sector. One of our favorite sectors at the moment in the United States are agency mortgage-backed securities. These are very liquid investments that benefit from a strong guarantee from an agency of the US government. They're now trading at yields and spreads that we haven't seen since the global financial crisis of almost 15 years ago, yet they have next to no default risk. So again, an example of a very high quality asset at very, very attractive yields. There are also going to be considerable opportunities within the private investment markets. Over the last couple of years, we know that interest rates have gone up significantly and quite quickly. Equity valuations have dropped significantly and quite quickly. Private markets have yet to fully react. Over the course of the next several quarters, Valuations across the private markets are going to begin to catch up to their public market counterparts. It will be a somewhat disruptive process, but with it will provide opportunities like we haven't seen since the global financial crisis. Sure, and we're well aware that the rest of the world is very, very focused on the Federal Reserve's plans over the course of the next several quarters. So the bottom line is that we do believe that the Fed's modeling framework suggests that they may have tightened enough to get inflation back towards their target. So we do think that the central bank will look to pause interest rate increases at these levels, perhaps after one more 25 basis point tightening, and then they're inclined to wait and be very, very focused on the data. We absolutely believe that the central banks, if faced with a decision of getting inflation under control versus a potential for a hard landing in the United States, they're going to choose to continue to tighten policy. So our base case view is the Fed is probably close to the end of this tightening cycle, but there's certainly risks in both directions. Again, we think that they will likely keep rates somewhere in this 5% to 5.25% range and then stay there for an extended period of time. So we do believe that this banking crisis is going to continue to linger and impact markets for several more months. There's at least a chance that a few of the weaker regional banks will need to be acquired or perhaps addressed through an FDIC or a government process. So we don't believe that we're out of the woods yet, but at the same time, we don't believe that the risks to the banking system are anywhere close to what we saw during the global financial crisis of 2007 and 2008. We think bank transparency, in terms of balance sheet transparency, has improved a lot. The global banking sector has more capital, far more capital than it did back at that point in time. And we do think that these concerns or risks will be relatively well contained within the regional banking sector. So yes, they're going to continue to be a lot of volatility, perhaps a few additional problems that need to be resolved, but that we do think that this is manageable. However, with that said, this is a significant shock to the banking system in the United States and other areas around the world. We rely on banks to extend credit, particularly to small and medium-sized companies, to commercial real estate borrowers. And more regulation is coming as a result of this event. And that regulation is uncertain and a bit unpredictable. And we think that's going to create even further downward pressure on the economy. Interest rates have gone up very, very quickly over the last year. We do think there's going to continue to be a lot of strain across existing credit, either commercial real estate or corporate credit that was originated over the course of the last few years. And you're beginning to see a deterioration in credit fundamentals. If that's accompanied by some additional economic weakness, we're very well going to see a significant downgrade cycle over the next year or so as well. These trends operate slowly. We're already seeing signs within the public market valuations of similar companies under pressure. We're also seeing early signs of credit deterioration. And we think you're going to have a situation where ratings drop, in some cases from investment grade to below investment grade. And that's going to force a lot of selling into the marketplace. So investors that can get ready, stand poised to take advantage of these opportunities, we think are going to be rewarded with exceptionally high returns relative to the risks that they're taking. And then finally, anytime you've had such a significant global rate shock coming after such an extended period of aggressive credit issuance, and you very well may be in a recessionary environment, when most importantly, policymakers can't come to the rescue this time because inflation is elevated and debt levels are quite high coming out of COVID, you very well could have a more traditional distress cycle, a default cycle that we haven't seen in many, many years. So again, in that area of the opportunity set, very, very attractive opportunity for investors to target even higher returns by taking a bit more risk. Once again, we think that over the course of the next several years, we could be in as exciting an environment as we've seen again since the global financial crisis of 2008, 2009, 2010. So a variety of different approaches, a variety of different investment strategies, all leading to what we think can be very, very attractive returns over the course of the next several years. Sure. Within the commercial real estate sector, there's going to be some challenges, but also opportunities. There's some areas of the commercial real estate markets where longer-term fundamentals remain quite strong. Some examples of that would be anything tied to residential housing type investments, multifamily investments are going through a challenging time in response to the higher rate environment. But over the long term, the fundamental picture looks quite strong. So we do think areas like multifamily, logistics, industrial properties, even things like databases that have very, very strong secular tailwinds given the technological innovation and disruption that's going on, are all areas of the market that have been impacted short term by these higher rates, but should continue to provide very, very strong fundamental performance. At the other end of the extreme, there's going to be areas of the market that are going through longer term secular change. Things like areas of the retail sector, areas of the office market as well. Now, the office market is challenged, but it's very, very important to differentiate in terms of quality of the underlying office properties and location. For example, in New York right now, the office sector is going through a period of significant weakness. In the United States, there are very, very powerful work from home trends associated with post-COVID preferences or shifts in preferences. But even over the course of the last few weeks, we have been seeing some signs that people may be at least gradually returning back to the office. But we do think over the long term, there's going to be opportunities to generate attractive returns as we get through this stress and distress cycle within the office markets. The good news for end investors, though, that are looking for high returns with a more conservative overall investment profile, is that within the commercial real estate market, there's going to be a lot of very resilient, sound sectors and segments of the market that are going to generate very, very high returns without having to go all the way into the office space and take on more risk than you're comfortable taking. Well, over the long term, the biggest risk is just the fact that global debt levels appear to be unsustainable. During the COVID period, governments around the world took on more debt. It looks highly unlikely that this debt can be paid back. We did see in the United Kingdom not too long ago, the market react quite negatively in response to a deficit-fueled aggressive fiscal package. So we do think that in many areas of the world, many areas of the developed world, we're on track to end up having a problem at some point in the future.